For more on rates in the market, let's bring in Mike Schumacher, head of macro strategy at Wells Fargo Securities. Mike, great to have you with us here on set. What do you make of this move in rates that we've seen over the past month or so, and where are we headed?
Pretty messy, frankly. And from our point of view, what really changed things was Powell's comments on December 18th. We were, I'd say, modestly bullish until that point. Once he spoke, we said, no, done. Fed might cut a couple more times, but they're in no rush to do it. So why do you want to be long bonds at that particular stance? You probably don't. So from our standpoint, being long something like a 4 or 5 year treasury, fine. 10-year, 30-year, no particular reason to get long that at this point in time.
Right. I read in the notes that you seem to think that yields are not reflecting all the risks that are currently out there. So what are the risks that are not in the move higher yet? And how much higher can we move on those risks?
Yeah, it's really interesting, Melissa. When you think about markets, I'd say right now you've got so many different possibilities with this combination of central banks shifting gears, inflation, maybe it's sticky, maybe it's not, politicians getting into the fray, not just in the U.S. How many governments have fallen over the last couple months? Probably 5, 6. A lot of things to try to calculate. So from our standpoint, you can imagine a case where, let's say, Republicans actually get their act together, despite the speaker thing, and manage to pass legislation, not just extend the low taxes we have today, but cut them further. Budget deficit takes a hit, gets much bigger. People say, wow, this is bad news. Long-term rates can go up a lot. At the same time, if tariffs come in and they're big and broad-based, not just an extra 5 or 10 percentage points against China or something nutty against Mexico, but broad-based, other countries retaliate, that is almost universally bad for growth. You could see maybe not a global recession, but a slowdown. So in that case, I think people are underpricing the risk that yields go down a fair bit. So you've got one case where rates go up a lot on the long end, another which is maybe a 10 or 20% probability has them coming down quite a bit. So it's very difficult to try and sort out for investors and for your viewers all these odd scenarios now.
Tim brings this up a lot. What about the strength in the dollar, which doesn't seem to want to go down at this point? And at a certain level, I think that's going to be a tremendous headwind for equities.
Yeah, I'd agree with that guy. It's interesting. It makes me want to lean against it because pretty much every client I talk to says, oh, yeah, strong dollar, strong dollar. But you go through the arguments, and you all made a couple minutes ago, China, for instance, right? Big economic weakness, a lot of stimulus, lower yields. Contrast that with the U.S., pretty strong economy, higher rates. That big gap ought to drive the dollar a lot higher. I think it will. And yet client after client says the same thing. Dollar euro, vacation pricing looks pretty good if you're sitting here in New York. Yeah, let's go to London, Paris, whatever. Why not? It's 103. Does it go to parity? We think it does, probably in the next couple months. So I can make a lot of really good arguments for the dollar strengthening. I think it's difficult to get in the way of that right now, but I'd agree with you. Eventually, it becomes a pretty tangible headwind.
Mike, you might have just alluded to this with the sense that the dollar's going higher. That seems to be where your macro strategy guy. Where are the global macro funds? What's their trade for this year? We can look back on last year and we can see where there were some obvious places this group played. These are some of the biggest funds in the world. What's the strategy?
I think they're trying to figure that out, Tim, because they hit the Trump trade pretty well.
Yeah.
So you had to say, well, all right, rates go up, equities rally, dollar strengthens, boom, I'm in. So if you got even a couple of those right, it was a great year. But I'd say for this year, it's much more of a tough calculation because Trump's already in. That trade's run a fair bit. Do you really want to load up right now? Probably not. So I think they're trying to sort that out. They'll probably take their cues over the next month or two, I would think, in the U.S. once the new administration comes in. We actually see what it can do with Congress. Don't know yet. And once some of these tea leaves start to settle overseas, too.